Welcome to the Wealth Renegade podcast. I'm your host, Robby Butler. Have you celebrated your financial independence today? On today's show, there are numerous pieces of the private placement world that an investor can only learn about through experience. One of those, and the one I'm excited to bring to you today, is about co-investment, is where a sponsor places capital on the LP side with LP terms with the limited partners in the investment opportunity. However, most limited partners don't have much visibility into that element of their private placement opportunities. And so I've brought on my good friend, operator, syndicator, and private placement investor, Adam Penn, to talk about this. Adam, thank you for being here today.
Thanks for having me, Robby. I'm excited to be here and chat about investing in my own deals and some of the other deals I've passively invested in.
You've got what I would frankly describe as a ridiculous breadth of experience for the time that we've both been involved in our investing journey. So maybe before we dive into the asset classes you've dabbled in and the operations you have built on top of them, describe for me a little bit, what's your theory? Why do this as opposed to any other type of investment out there? What drives you to make these types of investments?
Yeah, so I'll start off by when you say experience. One thing I always like to say is that I jump off the bridge before I know if there's water underneath it. And I think I've hit the concrete a few more times than I'd like to admit, but it's definitely made me be able to pivot and learn some more things as we move. I found that just over the time period, one of my previous business partners was a stockbroker, and it was not a bad place to park cash for a little while, but overall, I just found better returns in real estate and in other forms of private placements. I've done some private equity stuff or like pre-IPO type of investments with SpaceX and Automation Anywhere and a few of those companies. But primarily, I'm focused around real estate. I just find that it provides better opportunities, both from the tax standpoint of things, as well as with just the return standpoint and multiple different types of income, right? When you look at a stock option, or a stock investment, you're really just either buying the appreciation or it's a pretty flat stock and you're just getting some dividends. Whereas with real estate, you're able to take advantage of tax benefits, dividends, a cash flow of, rents getting paid, and then appreciation of the building over time, paired with high quality debt that if in a stock portfolio, you'd have to take a margin loan and your risks are much higher.
So that describes a lot of what we know are the traditional attractive fundamentals that bring someone into the alternative space. Is there something deeper for you? Why do you like these types of private placements, especially the ones you mentioned, real estate, pre-IPO, perhaps small businesses with high growth potential or whatever the arrangement is? Why those? What's deeper than that?
I actually love the fact that you said alternative because I would really describe these as not being alternatives, right? These have been traditional for tens of thousands of years. And only in the last 100 years did we decide that betting our money on, large companies and having everyone invest in the same five companies was the traditional course of action. So I think really it just comes back down to more of a solid mindset of wealth building. Does that answer your question?
Oh, yes. Tell me more about the solid mindset.
For me, it's just there's the ability to have these assets that are cash flowing and a little safer, more liquid to a certain extent because you're getting more cash out of them. You have better tax benefits. And when you look at a 3-bedroom, 2-bath house, which a handful of my portfolio is, there's a lot of buyers for that, right? There's not as many buyers as there is for Apple stock. It's not as liquid as that, but it's not a hard asset to sell. And over 30 years, the mortgage gets paid down if you don't refinance it. But if you do refinance it, you get cash out without having to pay any tax on it.
You said it exactly right. The alternatives verbiage that the common investment industry uses is basically more made up than we care to admit. These are the real wealth builders of an economy, of a macroeconomic cycle. They're real assets. You've established companies not only to make your own investments in them, but to help others make investments in them. So I know your thesis is very deep, but let's move into a little of what you've done. So you talked about some of the assets you like and the reasons for liking them, but walk us through the first time you made a private placement investment. And then we'll talk a little about the co-investment side of things, but tell us how you first started pursuing these types of investments.
Yeah. So the first one would have been Airbnb before it went public. We got a private offering, it's a 506c offering to buy Airbnb stock. It was something my previous partner had done. He went through and sold pre-IPO shares. They'd get them from initial company members who had stock and wanted to sell them before the company could. They would make private offerings of them, and we were able to buy them at, I think they went public at $44, and I think we sold them at around $160 a share, and our entry price was 20. Still a stock price, still a great return. And there's other pre-IPOs that I bought around the similar time that still haven't gone public. I don't know if you know this or not. The stock market's not doing phenomenal right now, and no one wants to go public. And then, from there, we transitioned into, I've always had real estate, even prior to doing those private offerings. But then we wanted to be able to do more real estate and buy more deals and not have to continuously save up another down payment. And so I found that instead of having to save my own money to do another down payment, I was able to save whatever money I had, plus a bunch of investor money, and be able to do more deals on a faster time frame, build better teams, and still be able to invest alongside of them. But, for instance, I didn't have to save up another $150,000 to go buy the next one property. I was able to put $25,000, $50,000 of my money alongside of $1 million of investor cash and be able to use the same systems I have, but actually grow them faster.
So you've now done that across multiple asset classes. So tell us what you're exposed to, and then we'll talk about your co-investment model.
Yeah. So the first private placement we did was an oil and gas deal in December of 22, maybe 21. And the years blend together, especially on those December timelines. It's December. You're like, which year was it? And it was December. We wanted to do a deal. We were going to raise $1 million. We raised $175,000. It wasn't quite a million, but we learned a lot. I was one of the larger investors in there at 50,000 of my own dollars. And then that was an oil and gas deal. So we bought wells. They produce great tax benefits. So you normally get about 70 to 80% of what you invest in year one as a tax benefit. It can offset active income. I'm not a CPA, so obviously consult your own financial advisors, but that's a huge benefit of the oil and gas space. And then, it just starts kicking off cash flow as you produce oil, as long as the well is going to production. There's always the risk of any oil and gas investment that you would have dry wells, or a concern that the production is going to be lower than the cost to operate. But overall, you start with this great tax benefit and you hope to lead into production of oils, which is really an inflation hedge, right? Because oil is the baseline of all economies, and it's how everything is run off of. So as inflation goes up, the price of oil goes up, and that helps hedge your cash flow because it's, you're directly selling the crude oil. From there, we went into short-term rentals. We've done a few oil deals. We're going to probably continue to do them. And we went into short-term rentals. We opened up a fund about a year ago, raised close to $2 million, and we bought about 20 units. We're operating those as short-term rentals in Memphis, and we're looking at expanding into a few other markets in that area. And once again, just buying the real estate because we like the real estate, but the short-term rental side of it produces higher cash flow.
So because you've gotten to sit on both sides as a true passive, as an operator, and as a syndicator involving other investors to be able to make investments with you, what is your thought when you see an operator making a co-investment? What does that tell you about the deal, about the team? Tell us that.
I think it means that they have faith in their own project, right? And so every project we've done, even if I don't put cash into the deal, one of the other co-GPs has put cash into the deal. And I'm not avoiding putting cash in any deal because I don't like the deal. I wouldn't put the deal out there if I didn't like it, but there's just somewhere I'm not liquid at that point to make that investment. But we always have one of our GPs put some amount of cash into each deal, because I feel like it's the whole thing that if you went to a restaurant and asked the waiter, what are you eating? Well, what would you eat off this menu? And they say, oh, I wouldn't eat here. Then you shouldn't eat there. And it's going to be similar with the general partners investing in their own deal.
So how should a passive investor ask that question of the sponsor they're considering placing capital with, making an investment towards?
Yeah. I mean, the way that I get the question a lot is, are you invested in this deal? And if I'm not, my normal response is, so let's just talk about like a short-term rental deal. Yeah. If we put together another one, I might not put cash into it right away, but 70-80% of my portfolio is allocated to real estate, which is operated as a short-term rental. And I own a short-term rental management company where most of my time gets spent in operating the short-term rentals and managing the teams around operating the short-term rentals. Just because we're putting together another fund wouldn't mean that I'm not in that space. As long as the operator, if I'm talking to a guy who has 5,000 apartment units and he's been an asset manager for 15 years and he says, hey, I've got this great deal, but he's not putting any money into it. As long as his reasons make sense. Oh, I just bought a family house and my daughter got married and my wife wanted a car and we're going to Hawaii and I just invested in this other deal 6 months prior. Well, maybe that makes sense. I think at the end of the day, it's just a logical conclusion to is the investor's interest and your interest aligned, or the general partner's interest and the investor's interest.
From knowing you for a long time now, I know you have significant skill set in modeling deal opportunities. So is there anything an investor loses if is there anything a passive investor loses if the general partner is investing in the deals? You talk about alignment of interest. Well, does it take away anything? Do you have concerns if, for example, the co-investment level from the general partner is 40% or something very high?
I think as long as their class is classified in the same, most investments like this have, two classes of investors, call them A and B. The general partners will normally be the B class, and that's where the revenue share comes. And the A class is normally the passive investors. As long as you don't see the general partner sitting on some third class with his investment, so there's different rates of return. If he's sitting in the same class of investor as all the other passive investors, then it's no different. They have to treat themselves and all the other passive investors the same way based off of the operating agreement.
Is there any reason you ever wouldn't invest if there was no co-investment from let's say pre-IPO is perhaps a bad example here, but let's say you were considering another oil and gas investment. You said, I don't want to do this work anymore. I just want to get the benefits. So I'll pursue a passive investment, go into oil and gas, and you found out they weren't co-investing with you. What red flags would that set off? What would you do?
I think I would just want to understand how they found the deal and what they were looking for, right? What brought them to it and why they're not investing in it, or why none of their team is investing in it.
Have you ever seen things like that? Do you see people who avoid the co-investment model?
I don't know anyone who hasn't co-invested. I don't believe. The main thought that comes to mind is normally we're the last one to invest in the deal, not because we're the last one who wants to put our money into it, but because normally there's a small spot at the tail end and our investors want to fill up the deal. And maybe we need $66,000 to close, right? It's a weird number to go ask from an investor from, hey, do you want to fill up this last spot for 66,000? But, maybe we're going to put in up to 100,000 and fill whatever that final position is. Or especially on the oil and gas ones, we will get calls December 25th from someone saying, hey, we need a tax benefit, and we can not put in our position to give them the tax.
Very good point. Sometimes it is all about the timing, and over the longer time cycles, sponsors know that they're going to continue working their investor list, and over time, people will filter in at the right time. But in any case, this is a money game. And so you have to have the right amount of money to close the opportunity. And so the sponsor can bring in the last 36 cents or the last $200,000 to ensure that the deal moves over the line and the rest of the investors get their return on investment. Because in almost all cases, investors exist to invest, not to say no, not to run around, not just sit on cash, but because they're sitting on capital to invest, they have liquidity, they want to place it. The difference in between 17 and 18% IRR is not the main point. The point is, are they invested or are they not invested? So for people who want to learn more about the three businesses you run or more, at least the three investment opportunities you generally offer and what you're working on, how should they keep in touch? How can they reach out?
Yeah. So the easiest way to reach out to me is you could schedule a calendar event with me directly on our website, bidwellcapitalfund.com, or you can shoot me a text and we can start a conversation. My phone number is 530-230-0557. And, we do short-term rental management if that's anything anyone's interested in. We do free audits of your properties and listing optimization so we can chat about how to make sure they're performing at peak opportunities. And then, you know, oil and gas is something you're interested in, or being a passive investor in short-term rentals, let me know. Or if you've got some really interesting alternative class, as you said earlier, I'd love to hear about it and broaden my own horizons.
Very cool. I think you're the first investor, whether passive or active, on this podcast who's done pre-IPO shares and talked about it. So, Adam, thank you so much for being on this podcast. And for the listeners, please feel free to reach out to Adam, take advantage of his offerings and what he's doing, especially in the short-term rental space. And we'll look forward to seeing him in many of the conferences we attend as well.